When it comes to building my portfolio, I like to take a more balanced approach. Some growth stocks, some dividend stocks. But in today's video, we're going to be focusing on dividend stocks because I just did a video focusing on a few of my favorite growth stocks for the next 5 years. In today's video, we'll be focusing on 4 of my favorite dividend stocks for the next 5 years plus. All 4 of these companies hail from different sectors. I'm trying to give you a variety of options. And all of them, of course, pay dividends, but they pay growing dividends. And that's what I like. When I'm investing in dividend-focused stocks, I'm not as focused on the yield. I am more focused on the dividend growth. That's where the power of compounding gets put into overdrive. So make sure you stay tuned throughout the entirety of today's video so that you can see all 4 of these picks and let me know in the comments which of the 4 you like best. And do me a huge favor by simply clicking that like button down below. Really helps with the growth of the channel. I appreciate it. And make sure you subscribe so you're notified anytime we drop new content. And let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before I begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their top 10 stocks to buy right now. All right, let's jump back into our video, taking a look at 4 of my favorite dividend stocks for the next 5+ years. Beginning with dividend stock number 1, which is going to be Broadcom, stock ticker AVGO. This one shouldn't be much of a surprise or a shock, as this is one of the better performing companies across all sectors over the past handful of years. And with AI still in its infancy stages, I believe there's a long runway of growth for Broadcom ahead. The company currently has a market cap of $1.3 trillion. Over the past 12 months, shares are up 61%, and year to date, up nearly 20%. This is a stock that has been absolutely on a tear, not even talking about the dividend yet, and it's been outpacing many popular growth stocks on the market. Taking a look here at this fiscal.ai chart, look at Broadcom's performance compared to many of these companies. The names of Tesla, CrowdStrike, Alphabet, Microsoft, and Apple. Broadcom shares are up a staggering 895% over the past 5 years. The next closest on this list is CrowdStrike, which is up 350%. Why is Broadcom up so much? They have been executing to perfection and taking advantage of this AI boom. Here's a look at another fiscal.ai chart that I created, and all of these are customizable, so you can make all of them with the click of a button. But this shows you total revenue for the company broken out into 2 separate segments that the company operates in: their semiconductor solutions and their infrastructure software. And although semiconductor is the largest segment, look at the growth from the blue segment, the infrastructure software, just in the past 2 years alone, growing from $7.6 billion in 2023 to nearly $25 billion in the past 12 months. Revenue growth is great and all, but for me, even more important than that is free cash flow. And when you look at this free cash flow chart for Broadcom, you can see that it has exploded over the past decade, from $11.7 billion to $22.7 billion over the past 12 months. Free cash flow is what makes any company grow, but free cash flow is what makes the dividend grow. And speaking of the dividend, this is going to be the lowest yield on our list at just below 1%. And it's hard to believe a few years back that yield was over 4%. But with the explosion in the stock price, yields have come down. The company pays a $2 per share dividend and has a 5-year dividend growth rate of more than 13%. So with Broadcom, you've got the best of both worlds: a share price that has been soaring high and a solid growing dividend. But with performances like we've seen, the stock has gotten a bit expensive. So luckily, I own some right now, but not looking to buy any at the moment. So where would I prefer to buy this stock? Probably closer to that $220 level, as that would put the stock at around a 27 times PE multiple, which isn't all that bad. And that leads us to dividend stock number 2, which is going to be the Home Depot, stock ticker HD. And like Broadcom, the Home Depot has been a great compounder with share price appreciation and dividend growth over a long period of time. However, over the past few years, Home Depot shares and results have struggled. largely due to higher interest rates, which have impacted negatively the real estate sector. But remember, as investors, we want to be ahead of the curve. And what do we see on the horizon? Interest rates are going to come down, which is going to be a pressure release valve for the real estate market and definitely help a company like Home Depot. The other thing to think about is the fact that Home Depot is largely immune to the threat of Amazon, something that all investors need to think about when looking into a retail type company. There's not a lot of folks that are going to be buying live plants or 2x4s on Amazon. They're going to go pick them up in person. When it comes to Home Depot, they currently have a market cap of $371 billion. Over the past 12 months, shares are up 5%, but year to date, they're down 5%. Again, this is a company that is in dire need of a rate cut to definitely help get the wheels turning for that real estate market. Jumping back over to fiscal.ai, we can see that over the past 5 years, on a total return basis, close competitor Lowe's has actually outperformed Home Depot to the tune of 80% versus 67%. This is something I talked about a lot over the past few years, ever since CEO Marvin Ellison came into the top position at Lowe's. If you look at his background, where did he used to work? He was in a senior leadership role over at the Home Depot, and he's been making a lot of adjustments there to close the gap between these two companies. But still, if both of these companies were lined up and they were at the same valuation, I would still put Home Depot a notch ahead. Here's a look at another fiscal.ai chart that I created showing Home Depot's revenues over the past decade. But things have really plateaued over the past 3 years, as you can see. And here we can look at free cash flow, which has actually been decreasing for the past few years. But with rate cuts coming, that can helpfully turn things around. We need free cash flow to fund that dividend. And speaking of the dividend, the company currently pays an annual dividend of $9.20 per share, which equates to a dividend yield of 2.5%. They have a 5-year dividend growth rate of 10% and 15 consecutive years of dividend growth. So where would I prefer to buy this stock? Well, right now, as you can see, the stock looks a little expensive, trading above their 5-year PE and their 5-year EV to EBITDA. A price to earnings multiple closer to around 21 times would be more ideal for me to enter a position, and that would put the stock price roughly around $315, which is 15% below today's market price. And that leads us to dividend stock number 3, which is going to be NextEra Energy, stock ticker NEE. And in case I didn't tell you at the start, the order in which we're going through these 4 dividend stocks is going from the lowest dividend yield to the highest dividend yield. We started with Broadcom, which is slightly below 1%. Then we went to Home Depot, which is at 2.5% dividend yield. And now NextEra, which is hovering around a 3% dividend yield. And the stock for NextEra, though, has been a little bit more volatile than usual. A lot of that has to do with this big, beautiful tax bill that came into effect and passed. The stock fell off when the House voted on it. The stock fell off when the Senate voted on it. And if you're part of my Discord community, the Stock Investors Edge, I was pounding the table on buy the dip. And if you followed along in that buy alert, you were handsomely rewarded. And if you're interested in seeing any of my positions from a stock perspective or an options perspective, then consider subscribing to the Stock Investors Edge. And you can catch that link down in the description below. Now getting back into NextEra, which is within my portfolio, this is a company that hails out of the utility sector. They have a market cap of $154 billion. Over the past 12 months, shares are down 1% and year to date up just 3%. So again, when looking at those percentages, taking a step back, it looks like a stock that, like Home Depot, hasn't really moved all that much over the past 12 months. However, on a year-to-date perspective, this is a stock that's been as low as $61 and as high as around $76. That's a 25% difference right there. So again, what has caused all of this volatility? The government and the new spending bill, which has really taken away a lot of the credits that has gone towards renewables. And that sent investors to hit the sell button on NextEra. But what that told me was there's a lot of investors out there that don't really understand NextEra because first and foremost, they are one of the largest utility companies. Yes, they have some renewable resources focusing on solar and things like that, but that's not the biggest part of the business. Will the new spending bill provide a headwind for the company? Absolutely, in the near term, but I don't think it's going to cause a hiccup in results over the next 5 years. This is a fantastic company to own, a compounder of wealth. And if there's one thing that we can all agree on, it's the fact that this country needs more power. And that's where NextEra comes in. NextEra is here to stay. NextEra is going to continue to compound over the next 5+ years. And in addition to that, they're going to pay a nice, juicy, fast-growing dividend that currently sits at a $2 dividend with a 3.3% dividend yield, a 5-year dividend growth rate of 10%, and they are a dividend aristocrat, meaning they have paid a growing dividend for more than 25 consecutive years. Looking here at this Fiscal.ai chart, you can see the company is trading at a discount to its historical 5-year average for both an EV to EBITDA perspective and a price to earnings perspective. The PE currently sits at 20.3 times, well below their historical 5-year average of 25.2, and EV to EBITDA sits at 18.5, well below their 5-year average of 22.8 times. So if this stock were to go into that mid-$60 range, I would yet again be adding to this position, as it will be a compounder of wealth for years to come. And that leads us to dividend stock number 4 on our list, which is going to be AbbVie, stock ticker ABBV. So this is going to be the highest yield position of the 4 right here, but this is also the longest held position within my portfolio. AbbVie was a spinoff from Abbott Labs, but now when you compare the two companies, AbbVie is much larger, and they hail out of the healthcare sector, particularly a pharmaceutical company that currently has a market cap of $344 billion. Over the past 12 months, shares of AbbVie have climbed nearly 15%, and year to date, they're up nearly 10%. AbbVie for years had the #1 selling drug in the world in Humira, which got FDA approval back in 2002, and that started a 20-year run. Looking at this chart here, you could see how fast global sales grew for the single drug, but then came 2023, when the drug's patent expired and cheaper generics flooded the market, something that was not a surprise and expected. Many doubted the company after this, but something that I constantly talked about was how the company was strengthening itself, strengthening its pipeline, diversifying its products as well. And lo and behold, what do we have now? Skyrizi and Rinvoq, which are growing at an extreme rate of speed. And the two of them together are expected to be larger than Humira was, which again was the #1 selling drug in the world for a number of years. Looking at this chart here, you can see how the growth in these drugs and what percentage of total AbbVie sales they're accounting for. And right now, they're approaching 40%. Taking a look now at this Fiscal.ai chart, we can see revenues and operating profit over the past decade and how things have stalled out after 2022, which coincides with the Humira patent expiration. But this was, again, known, and management prepared investors for this. So again, Skyrizi and Rinvoq continue to grow. This is a great management team with a solid balance sheet and a company that's diversifying its product line and building its pipeline. And best of all, people are starting to take note. Over the past 5 years, this is a stock that has actually outpaced the S&P 500 to the tune of 140% versus the S&P 500's 112% return. So with the future still looking solid, we can expect more upside and also a solid dividend that currently sits at $6 per share with a 3.5% dividend yield to go along with a 5-year dividend growth rate of 7%, something I expect to increase over time, and 11 consecutive years of dividend growth. However, given the strong performance in the stock, shares are not all that cheap as they once were when they were trading in the single digits in terms of a PE multiple. Today, that PE multiple sits at 15 times, and I would like to see that closer to 12 times before I look to add to one of my favorite positions, which would equate to a target buy price in the range of $150 to $155 per share. So there we just looked at 4 very different companies, all paying growing dividends. In the comment section, let me know which of these 4 are already in your portfolio and which of these 4 do you think you will add to within your portfolio. Thanks again for supporting the channel, and do me a huge favor, click that like button down below. And if you haven't yet, subscribe to the channel so you're notified anytime we drop new content, and we'll see you in the next one. Take care.